In this video, I'm going to talk about the weighted average cost of capital for a firm and how we calculate it. Before I get started with the calculation, though, I want to talk a little bit about why we calculate the weighted average cost of capital. So, the weighted average cost of capital is the required rate of return that a firm has for its project. So when we talk about capital budgeting, we use that weighted average cost of capital as the discount rate, as the rate of return that the company must earn on its investments in order to make those investments make sense for the company to take on. We calculate the weighted average cost of capital because the money that a company gets comes from investors. And in order to justify using that money, they have to provide a return to those investors or an expected return to those investors in order to compensate them for giving up their money to the company for investment. So, for example, I'm going to pull up a website here, bankrate.com. So this is bankrate.com. It's just a website that has different investments or different rates of return or products or loans on it that you can look at. So I'm going to go out here and pull up the CD rate. So a CD, or a certificate of deposit, is a time deposit at the bank. Typically, you might see a CD be advertised for a 1-year maturity. So I'm going to go out and I'm going to invest in this CD. I'm going to put my money in it, and in a year they're going to give me my money back. And during that year, they're also going to pay me interest on my money. Okay, so I'll just give you an example here. This CD from Goldman Sachs here, currently the term is 14 months. So I would put my money into that CD, a minimum of $500 according to the information here, and I would usually, on a certificate of deposit, earn quarterly interest on that. So they're going to pay me interest every 3 months on that. And right now they are advertising an annual percentage yield of 5.4%. So they're going to be paying me 5.4% for my money. That's the rate of return I'll receive on my money on an annual basis. Now, if Goldman Sachs put out a CD out here saying 0% return, they probably wouldn't get anyone to buy their CDs or invest in their CDs, because people require return in order to give up their money for a time. And so banks and financial institutions often advertise certificate of deposit rates. They're advertising that they're going to pay you a certain amount of money or a certain return in order to induce you to give up your money for a period of time. And so that's why we have to calculate and have to determine what the required rate of return is for the different investors into a business. So the investors for a business, we're going to break them down here in a minute, but they generally consist of common stockholders, bondholders, or other lenders such as banks, and in some cases preferred stockholders. And we'll talk about kind of the special case of that as we go through this as well. But what I want you to know is this statement here. For an investment, a stock or bond, etc., to have value in the market, investors must expect that the investment will provide benefits for them in the future. In general, we expect those benefits to be cash flows. So when I buy a stock, I expect to receive, hopefully sometime in the future, a dividend payment from that stock. Or the company is going to repurchase my stock at a higher price. But the company has to generate cash and pay that cash out to me in the future. And if I don't expect that as the investor, I'm not going to buy that stock. The same thing applies with bonds. In order to induce me to buy a bond, that company, whoever's selling that bond, has to make an agreement with me to pay interest payments to me in the future. And then at maturity, they're also saying they're going to pay me the principal value of that bond. And that's why that bond has value today, is because there's an expectation that the company is going to pay me even more money in the future if I give them money today. So, in general, the benefit provided in the future is generally considered to be cash flows. Okay. A dividend payment, an interest payment, the principal at maturity, maybe a higher stock price in the future. Some investments provide other types of benefits, but we're not going to dig into those too much in here, especially in this topic area. But some people do invest for impacting their communities and to receive other benefits from that investment other than just dollar returns. But for our purposes, we're going to focus on dollar returns at this point. So the weighted average cost of capital is the discount rate at which the cash flows of the firm or the cash flows of a project are discounted back to today to determine its value. So later on when we talk about capital budgeting, we use the weighted average cost of capital for the firm to determine what the value of a project is today. We also use the weighted average cost of capital to determine the value of a company today based on the expected cash flows. The cash flows we expect that company to generate in the future. So the weighted average cost of capital is the weighted average of the required rates of return for the investors, and again, those are the stockholders, the preferred stockholders, and the debt holders of the firm. The equation to calculate the weighted average cost of capital looks like this. Weighted average cost of capital is equal to the weight of debt, and we'll put this down below, multiplied by the cost of debt, multiplied by 1 minus the tax rate, plus the weight of preferred stock, multiplied by the cost of preferred stock, plus the weight of equity or common equity, multiplied by the cost of equity or common equity, and we put all that together to get the weighted average cost of capital for the firm. So down here below, I'm just going to type in the definitions for each of these notations. R sub D is the cost of debt, or the required rate of return for debt. R sub S is the cost of, and I'll usually refer to this as the cost of equity, or the required rate of return for equity. And this is different than the next one, preferred stock or preferred equity. And we'll talk a little bit about the differences later, but when we're talking about the cost of equity, we're talking about the cost of common equity or common stock for the firm. If it's for preferred equity or preferred stock, we'd reference it directly as preferred stock or preferred equity. Actually, let me be consistent here. Preferred equity, or the required rate of return for preferred equity. The W's are all the weights. The weight of the capital component in the capital structure of the firm. For example, W sub D is the weight of debt in the capital structure, and we'll get into how we calculate that later on. And then T is the corporate tax rate for the firm. So returns for capital components, and our capital components are common equity, preferred equity, and debt, are commensurate with the risk of the components in order to induce investors to make their investments. In other words, the greater the riskiness of those future cash flows, the greater the expected return has to be in order to induce someone to invest in that company. So take, for example, if my company is a very solid old company and has been around a long time, isn't at really any risk of going into bankruptcy. If I issue a bond, I'm not going to have to pay a lot of interest for that bond because I'm not the risk is not very high. Okay. On the other hand, let's say I start up a brand new high tech firm and I'm selling equity in that firm. I'm going to probably have to offer a pretty high rate of return, or at least my investors are going to have to expect a high rate of return in order to induce them to give me money, because there's a much greater chance that they're not going to get their money back, and they don't really know what the returns will look like in terms of cash flows, until they do. So risk and return go together. The greater the risk, the higher the expected return for the investment. One thing I want you to know from this point of view is that for a given firm, the cost of debt, R sub D, must always be less than the cost of equity. Okay. This is because debt has a priority to the income and assets of the firm over equity. What that means is that if you buy a bond in a company and they don't make the interest payment, on time on that bond, they go into default, okay? And they can be forced into bankruptcy. If I buy stock in a company and I expect a dividend to be paid, but that dividend is not paid, the company doesn't go into default on anything. They're not forced into bankruptcy. The company will keep operating. The stock price will go down. The managers, probably may not keep their jobs, but the company won't go under for not paying its dividend. However, a company will go bankrupt if it does not pay its interest on its debts. Additionally, in the event of bankruptcy, if a company is liquidated, the bondholders and the lenders to the company get paid first. The debt holders get paid first. And if there's anything left over after they get paid, then the stockholders get something. But they don't get anything unless the debt holders are paid first. So for these reasons, the required rate of return for debt for a company has to be less than the required rate of return for equity for that company, because the equity for a given firm is riskier than the debt for the firm. So that's an important thing to remember. It's actually going to be something we talk about later on when we kind of evaluate the different options that we have for calculating the cost of equity. So the cost of debt is usually estimated by using the yield to maturity on outstanding bonds. The yield to maturity, what that means is that the yield to maturity is the annual return that a bond investor receives, and this is key here, if the bond is held until the maturity date. Okay. If you sell the bond earlier than that, you're probably going to get a different return than the yield to maturity. But the yield to maturity is set by the market. It's the rate of return, again, that you would receive if you purchased a corporate bond today and you held on to that bond until the maturity date. Your annual return would be that yield to maturity. Okay. The tax is deducted from the cost of debt because the interest paid on the debt is a deductible expense for tax purposes. This deduction creates a debt tax shield, which can significantly lower the cost of debt for a firm. So I'm going to scroll back up here and show you this. In the weighted average cost of capital equation, we have the weight of debt multiplied by the cost of debt, R sub D, and again, for us that would often be the yield to maturity on the firm's debt, multiplied by 1 minus the corporate tax rate. So this is this R sub D multiplied, there we go. Right, that part there that I've highlighted is the after-tax cost of debt. And we calculate it that way because whenever a company pays interest on their debt, they get to deduct that interest for tax purposes. So it lowers the effective cost of borrowing. If you have mortgage interest on your home and you itemize your taxes, you deduct the interest you pay on your home mortgage for tax purposes, and it has the same effect. It has the effect of lowering the effective cost of borrowing to pay, borrowing to purchase a home. So the deduction creates a debt tax shield, and later on in the course we're going to talk about capital structure, and we're going to determine the value of the debt tax shield for a corporation when they take on debt. But for now, what I want you to know is that this is an important reason why companies take on debt, because their ability to deduct interest for tax purposes lowers that cost and makes it substantially lower in many cases. So let's take a little break here from the notes. We're gonna look at a company. The company we're gonna look at is Caterpillar. I've got a couple of items here. So the first thing I've got here is called what's called a tear sheet, and this sheet gives us some basic information about the company. So Caterpillar manufactures and sells construction and mining equipment, off-highway diesel and natural gas engines, industrial gas turbines, diesel electric locomotives in the United States and internationally. And then it goes a little more information here about everything that they do. The company has a credit issuer credit rating of A. And what we'll find is actually that their bonds generally have this bond rating as well. This portion up here just gives a few key statistics. We're not going to worry about them right now. We're going to get most of our information on this type of information off of other spreadsheets. What we do want to focus on a little bit is the market data down here. So at the time that this video was recorded, the price of the stock for Caterpillar was $303.06. The beta, which we're going to talk about later on, was 1.12. The market cap, and this is in millions of dollars, so the market cap for Caterpillar was $154 billion at the time of this recording. The dividend yield is 1.7%, and what that means is that the annual dividends paid out by this company divided by the current stock price is 1.7%. So if you purchase this stock today at $303.06, you would expect to receive a 1.7% return from the dividend alone. Okay? So we also have the expectation that the stock price will increase in the future, and so that will also provide additional return for us. So what we're interested in, though, is calculating the cost of debt for Caterpillar. What we're going to use, and I've got this workbook out online too. What we're going to use is the yield on the firm's 10-year bonds. So that gives us an idea of what currently investors are paying and the return they're requiring on the firm's bonds. So I'm going out here to the summary tab, and I'm going to scroll down to sorry, I didn't have it at the top here. I'm going to scroll down from the top to benchmark securities. So we have two benchmark securities here, and Standard & Poor's Capital IQ usually provides the information in this format. So they usually got a bond out here that matures in 5 years and one that matures in 10 years. This one's a little bit longer than 10 years because it's the closest one that they have to a bond, Caterpillar has to a bond maturing in 10 years. The item here, so it says YTW, and I'll put this in the notes, but this stands for yield to worst. So I talked about the yield to maturity. Well, Capital IQ has a limited amount of space where they can put things, and so you could have the yield to maturity for a bond, but there's also the opportunity for, in some cases, the company to call the bond early, or there are other characteristics of a bond that might change the yield that an investor might receive on that bond. So, for example, if the bond is convertible. And so the yield to worst is the lowest return that an investor will receive, if they held it to the call date, or if it's converted, or if the investor holds it to maturity. So what this says is that, and these are the yield to maturities for these bonds. that the yield to maturity on this 10-year bond is 4.594%. So I'm going to go ahead and put that in there. Put that down as the cost of debt. And I'm going to actually go out here to the first tab, Caterpillar weighted average cost of capital, and put the yield to maturity here as equal to, and I'm going to put 0.04594 percent. So you see that I put that as 0.04594, so it makes it into a percentage, 4.59%. I'm also going to go look up the effective tax rate, and I'm going to look up the effective tax rate here on the income statement. So this is the income statement in the income statement tab, and I'm scrolling down here, down below the net income. It'll have the effective tax rate, and that is on, for this company, that's on line 90 here, the effective tax rate percentage. We can see here that it's actually been very stable. The most recent one, and I'll go back up to the top here, for the last 12 months ending September 30th, 2023, the effective tax rate for that 12-month period was 23.7%, which was very close to the actual fiscal year end before that of 23.6. So we'll go ahead and use this value here, 23.7% for the effective tax rate. And I'll put that in as 0.237, or 23.7%. So what we'll eventually do is use that to calculate the weighted average cost of capital. I'm going to go back out to the notes here. So for a Caterpillar, the yield to maturity on the firm's 10-year bonds, and what I mean by 10-year bonds is it's 10 years until maturity, approximately. For, like I said, for Caterpillar is more like 11 and a half years. It was the yield to maturity that was 4.594%. The effective tax rate was 23.7%. So that's our first capital cost, the cost of debt. Investors are requiring about 4.6% right now on the bonds that have 10 years to maturity for Caterpillar. And the effective tax rate is 23.7%. So that's actually going to lower the cost of borrowing for Caterpillar because, again, they get to deduct that interest for tax purposes. The next capital component that we'll talk about is preferred stock. So preferred stock is generally not issued by companies, especially ones that are not financial institutions. So preferred stock is generally issued by financial institutions. As a replacement for long-term debt. Financial institutions in the United States are required to maintain certain equity percentages in their capital structure. So primarily for banks in the U.S., they get their funding from deposits. And so whenever you go and you put your money in the bank, you deposit your money in the bank, they're going to take that money, they're going to lend it out. Most of the time they don't pay a lot of interest, at least in the last several years. They haven't paid a lot of interest on demand deposit accounts, so your checking accounts or your savings accounts, they tend not to pay a lot of interest on that. And that's good for the bank because it's cheap for them to raise money that way. But those deposits on their financial statements, on their balance sheet, are liabilities. And so the government and the Federal Reserve and the FDIC require banks to maintain a certain level of equity on their balance sheets. And So what they generally attempt to do then is to maximize their use of those low cost deposits, those low cost sources of funding. And what they don't want to do then is to issue bonds like other companies do that have higher required rates of return than what they're paying on their deposits. So in order to meet their capital requirements and their equity requirements, in lieu of issuing long-term bonds, they'll often issue preferred stock instead. And so the difference with preferred stock from common stock is that preferred stock generally has a set dividend. In other words, it's going to pay a predetermined dividend to the investor. And also that if the company were to go bankrupt, that preferred stockholder has a prior claim to the earnings and the assets of the company before common stockholders do. So from a financial perspective, financial analysts often see preferred stock as kind of a form of debt because, again, there's a predetermined payment, unlike a regular common dividend. And also, if the company goes out of business, the preferred stockholders are in line before the common stockholders in order to get paid. So preferred stock is generally issued by financial institutions as a replacement for long-term debt. Preferred stock generally has a fixed dividend. In some cases, the firm has to make up any missed preferred dividend payments before common stockholders receive a dividend. In the event of liquidation, so in other words, the company goes bankrupt and it's determined that the company should be liquidated, preferred stockholders receive the par value of their stock before common stockholders receive any residual value. In other words, preferred stockholders get paid first. As a result, like I said before, financial analysts often see preferred stock as really a form of debt for the company, although legally it's not debt. And this is all, I put all this in here to explain why most companies don't issue preferred stock except for financial institutions. So for Caterpillar, they don't have any preferred stock, as most companies don't. Okay. So I'm going to show you a preferred stock instead for Wells Fargo. So Wells Fargo, again, is a bank, and a lot of, especially larger banks, do issue preferred stock, and that's what we see here. So this stock pays, you can see here, forward dividend and yield. The forward dividend, the dividend expected in the next 12 months, and honestly, for this stock, it's every 12 months, okay, is $75. So if you bought this stock today for $1,219.98, you would expect to receive $75 in dividends over the next year. Okay, you get it in a quarterly amount, but it would pay out $75 over the year. And the next year you would expect the same dividend. The next year you'd expect the same dividend, and so on. So looking at this stock here, we can determine what the required rate of return would be for the investor if they're paying $12.1998 for the stock today, and they expect to receive a dividend of $75. So using this equation, and I'll explain this what this means here in a minute. We know the dividend for Wells Fargo is $75 a share, and we know the current price of the stock is $12.1998. So right now, I'm going to ignore this flotation cost item for just a minute to tell you what the required rate of return is for the company here. So 75 divided by 1219.98. Currently, investors, if you bought this stock today, you would expect to receive a return of 6.14% on the stock, because that dividend again is set and you're going to receive it every year. We include flotation cost because once a company issues that preferred stock, they're going to have what's called an initial public offering of the stock, and they're going to receive a big bunch of cash. In some way, they're going to get this cash either from an investment bank or they're going to get it from the investors that buy that stock, but they're going to receive a big pile of cash. Once they receive that big pile of cash, though, they don't generate any more money from that issuance for preferred stock. And so if Wells Fargo wanted to go back out again and get more funding from issuing preferred stock, they'd have to issue new shares, and there's a cost associated with that. Flotation cost, what I have right here, are also included because any new funding from preferred stock has to come from the issuance of new shares, and flotation costs are the cost of issuing those new shares. Flotation costs in general run between 5 to 10% of the cost of or the amount that's raised from a stock issuance. So I'm going to go on the lower end here and say it's 5%. So what that means is that, if Wells Fargo goes out and issues a new issue of preferred stock, they're going to have to pay investment banks, accountants, lawyers, and so on in order to get those actually created and sold. So using a flotation cost of 5% of the issuance issue proceeds, the cost of preferred stock is calculated as, so down here I'm going to put in 0.05 because we're going to say it's going to cost us 5% of any dollar that we issue in order to get the preferred shares issued. And so I'm going to go back out here to my calculator. So I'm going to take 75 divided by, and then in parentheses, I'm going to multiply the 1219.98 by 0.95, or 1 minus 0.05. And that gives me a cost of preferred stock of 6.47%. And again, this is not for Caterpillar. I wanted to give you a different example because Caterpillar doesn't have any preferred stock. But this is how we would calculate the cost of preferred stock for a firm if we needed to do that. The next one is the hard part. So with bonds, we can easily determine what the required rate of return is because it's actually in the bond quote. When we go out and look up a bond quote, and I showed you just the information from Capital IQ as well, it actually says on there the yield to maturity on this bond is this rate, and that is the required rate of return that the bondholders have for that bond. I showed you how to calculate it for preferred stock. Again, because we know the cash flows of that preferred stock, we know what that dividend is going to be every year. We can easily determine what the required rate of return is because as the stockholder there, I know what my dividends are. And I also know, and this is important, that those dividends are not going to grow in the future for in most cases for preferred stock. And so it's referred to as a perpetuity. This is not true for common stock. Common stock is not required to pay dividends, certainly not required to pay any set dividend. So we don't know what the cash flows are going to be from preferred stock in the future. We can guess and we can estimate what those are going to be, but we don't know for sure. And so we have to try to estimate what the required rate of return is for common stock, and there are many different ways to do that. I'm going to just go over a couple here in class just to show you some examples of how it's done, but understand that this is not a complete discussion on every different way to calculate the required rate of return or the cost of equity. So the cost of common stock or the cost of common equity is typically calculated without including flotation costs because the main source of common equity financing is retained earnings. So when you buy stock in a company, that company will hopefully generate positive earnings, and in theory, those earnings belong to you, the stockholder. Now, what the company will usually do is they're going to keep most, if not all, of those earnings, and they're going to reinvest them in the company. They're going to use, their profits to buy more equipment or buy more land or buy more buildings so they can make even more money in the future. Okay. From time to time, they might pay out some of this. So they might pay out some in the form of dividends, or they might pay out through stock repurchases, which we're going to talk about later on in the course. But most of the money that they're going to get from stock will come in the form of retained earnings. So whatever a company initially issues stock, they have an IPO, just like they do with the preferred stock, and they're going to get some money from it at that point in time. But they're going to also retain earnings that could be paid out to those stockholders throughout the life of the firm. So retained earnings are earnings that belong to the common stockholders, but they've been reinvested back into the firm. So why is it important to estimate the cost of retained earnings? It's because those costs of retained earnings, so that common stock, really does belong to the stockholders, and it should be earning a return for those stockholders. So why is it important to estimate the cost of retained earnings? Because retained earnings belong to the stockholders and should be earning a return commensurate with the risk that the stockholders take on by investing in the firm. Firms avoid issuing new equity for three reasons. I mentioned that we don't include flotation cost. We do with preferred stock because in order to get additional funds from preferred stock, the company has to issue additional shares. But companies often won't issue new shares of common stock, and there's three reasons for this. The first reason is that new issues of common stock dilute the ownership and control of existing common stockholders. So let's say you go out and you buy stock in a company and you own 10% of the company's stock. What that means is that whenever they, annually, whenever they vote for new board members, you control 10% of the votes. Okay? Whenever they pay dividends, common dividends, you get 10% of the dividends. However, if the company started then issuing new shares of common stock, then your control would be diluted unless you bought more shares of the stock. And so your power over the company would go down if they issued additional shares, and your percentage of the dividends, whenever they get paid out, would be lower. And so most common stockholders don't like that, and so the company avoids upsetting those common stockholders by not issuing new shares of stock. And from time to time, companies will issue small amounts of common stock, and that's seen as okay if they're using it for the purposes of executive compensation. So let's say, a new CEO gets hired and they want to provide stock to that CEO in order to get the CEO to work on behalf of the stockholders, and that's very common. That's usually seen as okay, issuing some shares to that, for that purpose, or issuing shares of common stock so that whenever the executives exercise their stock options, that there's shares to give them for that purpose. That's generally seen as okay. However, beyond that, companies generally avoid issuing what's called secondary offerings of their common stock to the general public. So that's one reason. Secondly, it's expensive. We talked about flotation costs for preferred stock. Those flotation costs exist for common stock as well. So flotation costs are high for common stock, and so it's expensive to issue new shares of common stock or new issuances of common stock. And then finally, it sends a signal that the current price of the stock in the market is too high. Companies really avoid sending the signal that the stock price is too high. So the reason why this sends that signal is that if I'm sitting here with my shares of stock, and let's say they're priced in the market for $20 a share, but I really think as a stockholder they're worth $25 a share, I'm not going to sell my shares of stock for $20 because I believe they're worth more. And generally, the management of a company wants investors in the marketplace to believe that the stock is worth more than what it's selling for in the marketplace, that the stock is undervalued, okay, in order to get them to pay more for the stock. If the company is out there selling new shares of stock into the marketplace for the current market price, what they're saying is that, at the very least, that price in the market is fair. Okay. And generally, the way that the market interprets new issuances of common stock is that the market price is in fact too high, because that's why the company wants to sell more shares. It's actually they're being sold in the market for more than they're actually worth. If you think back to COVID and what was going on in the stock market at that time, there was a situation with GameStop where it was called a short squeeze, and I won't go into it too much here, but essentially the stock price of GameStop got pushed up really high, and I'll just show it to you here momentarily. So you can see here, this is the chart, a 5-year chart for GameStop. And you can see right here in 2021, the stock price went from $4 a share, about $4 a share, well actually it says $3.33 a share here, and it popped up to here we go, $81 a share, okay? Incredible increase, and that was referred to as a short squeeze. It's a little bit complicated, but essentially some market participants were trying to manipulate the stock price into being much higher than it was really worth, okay? And then you can see it went back down, then went back up again, and it's actually, it's gone down quite a bit since then, but certainly higher than it was before that short squeeze. So I'm going to show you another company here, AMC. AMC Entertainment Holdings is a theater chain. Something similar happened with AMC. And it wasn't quite as dramatic. You can see out here that the stock for a while was selling for $42 a share, $40 a share, $50, and then it was going down $21 a share, and then it popped up just like what was going on with GameStop. And I'm showing you out here $592.60 a share. Somewhere along here, not at this peak, but somewhere along here where the stock price was really quite high, AMC started selling new shares. Okay. And really they knew, and the management knew, that the stock was overvalued in the marketplace, but they were taking advantage of that situation in order to bring in more money for a company that was really struggling at the time. But that's just an example there of a situation where we knew the stock was higher than it should have been, and the company actually took advantage of that, kind of ignoring the idea that they were telling the market it was too high, the price was too high. But anyway, those are 3 reasons why companies generally avoid issuing new shares. I'm going to go over just a couple of methods of calculating the cost of equity here. And again, these are just a few different ways to do this. So the 2 methods of estimating the cost of equity that we're going to go through are the discounted cash flow approach and the capital asset pricing model approach. The discounted cash flow approach says that the required rate of return for equity, R sub S, is equal to D1 over P0, and that is the dividend yield, plus some expected growth rate in the price of the stock. Okay, so this is equal to the dividend yield plus the capital gains growth rate. And again, the capital gains growth rate is the expected percentage increase in the price of the stock on an annual basis. We can estimate the capital gains growth rate in a couple of different ways. We can use a historical growth rate, and this is actually a historical dividend growth rate. Or we can use a retention growth model, which is calculated as the return on equity multiplied by 1 minus the payout ratio. And finally, we'll use analyst forecast for growth. So the historic dividend growth rate, we'll do an example of this with Caterpillar, but it's typically what we would use is the past 5 years of annual dividend growth. And I'll show you how to calculate that. The next one is the ROE multiplied by 1 minus the payout ratio. So the payout ratio is equal to the dividends per share divided by the earnings per share. And then we have finally the analyst forecast. In each case, one thing I want you to remember is that these are just the growth rates. For each one of these, we add to it the dividend yield. Okay, the expected dividends over the next year divided by the price today. So let's go back out here to Caterpillar, and we're going to calculate these 3 things for Caterpillar. So I'm right over here on B9, the cost of equity methods and inputs. So we're looking at the discounted cash flow methods, the dividend yield, and we actually saw this earlier when we looked at the tear sheet for the company. I'll just pull that up again. So the dividend yield is right here at 1.7%. So I'm going to put in here 0.017. And then we're going to calculate the historic dividend growth rate. In order to get that information, I'm going to go out here to the consensus tab, and this is an estimates tab. And what you see here is DPS, which stands for dividends per share. And I'm going to grab the previous 6 years worth of dividends. Okay, and so what that's going to give me is 5 growth rates over that 6-year period. So where I have my cursor, it says 3.11A. That means $3.11. That was the amount of dividends paid out in 2017. A means actual. Where you see E, that's an estimate. So we have an estimate at the time that I recorded this. The end of the fiscal year for 2023 hadn't occurred yet, hadn't been reported yet for Caterpillar. So we won't use that one. We're going to use 2022, 2021, 2020, 2019, 2018, and 2017 as our 6 years. So I'm just copying those dividends. I'm going to bring them back up here to my sheet, and I'm just going to paste them over here. So these are the past 5 years of dividends. And now I'm just going to calculate the growth rate from one year to the next. So I'm going to take equals. Hopefully this will work. I may have to make a little adjustment here. This was the 2022 dividend of 4.71 divided by 4.36. And then I'm going to subtract 1 from that. So I'll put the year up here. So the dividend grew by 8.03% from 2021 to 2022. Now that I've calculated that for 1 year, I can drag it out here for the rest of the years. And note that I didn't do this for 2017 because it would just give me an error. It wouldn't make any sense because there's no 2016 to calculate it from. So looking at this information, I see the growth rate was 8% 1 year, 17.6% the next year, which is a pretty high growth rate. Then it slowed down a little bit to 4% the following year, about 6%, 5.825% in 2021, and then 8.03% in 2022. So I'm going to say here that the historic dividend growth rate is equal to the average of the growth rates for these 5 years. So I get 8.75%. And that makes kind of sense. You know, you might play around with that a little bit. Could be 8% or something like that as well from the previous year. But that's what we'll stick with here. The analyst estimates for growth. I'm going to go back out here to this tab for this consensus. So I'm looking at the long-term growth rate, and this is expected to be the growth rate in earnings for the next 5 years, the average per year. And what I typically use here is the median value. So this is the middle estimate of the estimates that analysts have for this company, and they say that it's 13.5%. So analysts expect the earnings for this company to grow 13.5% per year for the next 5 years on average. So I'm going to put 13.5% here. And then now the ROE times the retention rate. This is going to be equal to the return on equity multiplied by 1 minus the payout ratio. So I'm going to put in here equals. I'm going to go out to ratios. And I will use the last 12 months. It's going to be pretty high. There's return on equity and there's return on common equity. You can see they're almost identical. I'll use the return on common equity, although it's not going to have a big impact on that. And then we multiply that return on common equity by 1 minus the payout ratio. And so I'm going to scroll down here. Actually, I'm going to not scroll out here. I'm going to go to the income statement. And you can see here it says payout ratio percentage, and I apologize, I'll start off the top here. and scroll down. So for this company, it is on line 80, but it's the payout ratio percentage. And I'm going out here for the last 12 months. So it's 1 minus the payout ratio. 1 minus the payout ratio is the retention rate or the retention ratio. And so what that tells us is that the ROE was 50% for the company. The retention rate was 27%. And so they're actually retaining most of their earnings. And the idea behind the ROE times retention rate is that the return for any retained earnings should be equal to approximately the return they're currently getting on their equity. For Caterpillar, their ROE is extremely high right now at 50%. That's an incredibly high return on equity, and so that will have an impact on the validity of this as an estimate for the cost of equity for the firm. But we have 3 different growth rates here. And so now I'm going to go down below here where it says cost of equity estimate. So right up here, we're just looking at the growth rates. So for this, we're just going to add the yields, the dividend yield to that growth rate to calculate the cost of equity estimate. So I'm going to take equals 1.7 plus that historic dividend growth rate of 8.75%. For the second one, I'm going to take 1.7 plus the 13.5%. So in each case, I'm taking the dividend yield plus the growth rate. In the last case, I'm taking the 1.7 plus the ROE times the retention rate to get 38.24%. So now I'm going to go back to the notes, and I'm just going to make a little bit of a note here on the retention growth method. Again, just repeating what I said before about why we consider this method. So the idea behind the retention growth model is that the firm is expected to be able to provide the same return on the earnings that it retains as it does with its existing equity. And so just a little note to say that And so that's the principle behind using that as a potential growth rate for a firm. Moving on to the next topic or type of cost of equity calculation is the capital asset pricing model. This differs from the previous one because with the previous model, we looked at the dividend yield, which is a source of return for the investor. I'm going to get a dividend, usually 4 times a year if I buy or pay for a share of stock today. Plus, I'm going to get the growth rate in the value of that stock. The capital asset pricing model, instead of looking at the expected returns in terms of dividend and price growth, looks at the required rate of return from the perspective of the risk that the investor is taking on. So the premise behind the CAPM is that investors are rational and risk averse. The risk of a firm are either firm-specific or a market risk. A firm-specific risk is a risk that is select to only a firm or a small group of firms. Firm-specific risks include things like product liability, product obsolescence. In other words, a product just being out of favor, people don't want it anymore, or managerial malfeasance. Managers doing things they shouldn't. Firm-specific risks, by definition, generally only affect the specific firm. So, for example, not too long ago, Boeing had, not Boeing, Alaska Airlines had a plane for which a panel flew off. A portion of the plane actually fell off during flight. Okay, so this was, not attributed to Alaska Airlines, but rather to the manufacturer of the plane, Boeing. This is a firm-specific risk because this is a risk that does not impact Airbus. It does not impact Lockheed Martin, the other competitors to Boeing. In fact, they're probably going to do a little bit better because of this, because they are not having those problems that Boeing's having. So that would be an example of a firm-specific risk. A market risk is a risk that affects most companies that are out there. So, for example, an increase in interest rates impacts most companies in some manner. If interest rates go up, the cost of borrowing for companies goes up. It also increases the cost of the customers of those companies. So, if interest rates increase and people are paying a higher rate of interest, for the things that they buy, then people won't buy as much when they go to Walmart, for example. This risk impacts companies like car companies more, because when interest rates go up, the demand for cars goes down because people are less likely to borrow money to buy a car. When mortgage interest rates go up, this has a big impact on the real estate market because people don't want to buy or can't afford to buy houses then. And so these are market risks. These are risks that affect most companies. Things like changes in interest rates, changes in inflation, the economy in general, oil prices, and things like that. The idea behind the capital asset pricing model is that a rational investor will diversify and not invest in just one company or a handful of companies, but they'll diversify their investments across many companies. And the idea behind doing that is they diversify away that firm-specific risk. So if Ford cars start blowing up, well, I might own some Ford stock, but I'm a rational investor, so I don't just own Ford stock. I might own some Ford stock and some General Motors stock and some Tesla stock and some Volkswagen stock. And so if one of those companies runs into a firm-specific problem, well, the stock price for that company will likely fall. But the stock prices of their competitors will probably go up a little bit because some of the demand for Ford is going to move over to those other companies. Okay. And again, this is the idea behind the capital asset pricing model, is that the only risk that should be rewarded is market risk, not firm-specific risk, because a rational investor will avoid or will diversify away that firm-specific risk. And so the capital asset pricing model says that we can measure market risk using what's called beta. And it's calculated as, and I won't ask you to calculate this, but the way that we calculate beta is that it is the standard deviation of the returns for the individual investment divided by the standard deviation of the returns for the market multiplied by the correlation of the two. Okay. So I'll just summarize CAPM here. Capital M is the capital asset pricing model. It says that the only relevant risk for an investment is the market, and this is also known as the systematic risk, since firm-specific risk can be diversified away. Some companies that are likely to have high betas, we can actually look up some companies to see what those would be. I can tell you one is Tesla. Tesla tends to have a high beta because it is a company that is young. It has it has a product that's often seen as a luxury brand. And so it is sensitive to economic turmoil. Luxury brands tend to be. And we can see here, and I'm just pulling up Tesla's tear sheet, it's got a beta of 2.32, which means that it's more than twice as risky as the average stock. So the average stock beta is 1. And so this would mean that it has a very high rate of beta compared to the average company. Other ones might include, I'm going to put in Tiffany. It's no longer publicly traded. VF Corp. VF Corp manages many like high-end brands like Supreme, North Face, Timberland, Smartwool. So kind of luxury brands. The beta isn't incredibly high, but it is fairly high at 1.58. So it is sensitive. This company's stock is sensitive to market fluctuations. Lower beta firms would include firms like Walmart. We can see here Walmart has a beta of 0.48, so much less than the average stock of 1. Dollar General. So Dollar General is a discount retailer, and again a fairly low beta of 0.41. Not very sensitive to market risks. In general, betas will be greater than 0, but they don't have to be. They don't have to be. So some examples of firms that are likely to have high betas, I said Tesla, VF Corp, and other companies that sell luxury brands tend to be sensitive to market fluctuations. Bank of America has a fairly high beta. And again, it's a very large bank, so it is sensitive to changes in the economy. It's very sensitive to changes in interest rates. Examples of firms that are likely to have low betas, I showed you a few. Walmart, Dollar General. Show you one more here. Molson Coors is generally, here we go. They make Coors beer among other things. So a kind of a lower cost beer. It's not extremely low, but it is less than 1. It's 0.89. So it isn't very sensitive to market fluctuations. So the basis, the end result of this is that we have the security market line, which is used in the capital asset pricing model to determine what the required rate of return for an investment should be. What the security market line says is that the cost of equity should be equal to the risk-free rate plus the beta for the firm multiplied what's called by the market risk premium, or RP sub M. So what we do here is we take the risk-free rate and we add to that the beta multiplied by the market risk premium. So we'll start here with the risk-free rate. The yield to maturity on the 10-year U.S. Treasury is frequently used as a proxy for the risk-free rate. The reason being is that if you bought a U.S. Treasury today, 10 10-year treasury and you held it for 10 years, you would receive the yield to maturity on that debt, unless the government of the United States defaulted on its debts, which it has never done in its history. Okay. The government is different than a corporation because the government can also print money, it can also tax, so it has many ways of making sure it can pay its debts. And so as a result, its debts, the U.S. government's debts, are considered to be free of default risk. You might notice that I said the 10-year U.S. Treasury, so this would be a Treasury that has 10 years left to maturity. This is similar to what we use for the corporate bond. For the corporate bond, for the cost of debt, we use the yield on a corporate bond for the company that has approximately 10 years left. The 10 years is frequently used because that's considered to be a normal investment horizon, for an investor or for a company. Some people do use the yield on the 1-year U.S. Treasury, and that's fine to do. You just have to make some other adjustments to the market risk premium in order to do that. The market risk premium is the estimate of the return that investors require for investing in the average stock in excess of the risk-free rate. So if we say that, for example, the yield on the 10-year U.S. Treasury is, and we'll look it up here in a minute, but let's say it's about 5%. Well, then if investors require on average an 11% return on the average stock, then the risk premium would be 6%, the difference between the two. And so that's the idea of the market risk premium. The market risk premium does fluctuate. Sometimes it's lower, sometimes it's higher, and that depends primarily on how investors feel about the market, how much risk aversion they have. So are they trying to avoid risk, or do they see a lot of risk coming in the future? And the greater the level of risk aversion, or the greater the perception of the riskiness of the market, the greater that market risk premium is going to be. So when times are good and the skies are blue and people feel good about the future, that market risk premium goes down. The required return in excess of the risk-free rate that people require decreases. When people are fearful about the future, or they feel like there could be a lot of volatility coming, that market risk premium increases. Let me show you what happens as a result of that. So I'm going to go out here, and I'm just going to pull up the S&P 500. It is kind of the standard index for measuring the market. There we go. So this is the S&P 500 index. And I'm going to take us back to the beginning of COVID-19. Back here you can see this was in March of 2020. This is kind of when COVID-19 hit, and you can see this big drop. So looking on the right-hand side in the black tag there, it says the price or the value of the S&P 500 as of February 17th, 2020 was $3,337.75. Go forward a couple weeks, and it dropped to $2,304.92. So a dramatic decrease in the value of the stock market. And you see it lasted just a few weeks, and then it started coming back up again. What happened here was that investors got very scared. Things were shutting down. People didn't know what the response was going to be and how bad this would be. And so the market risk premium increased dramatically at that time. People started pulling back. They started pulling their money out of the stock market and selling their investments, which lowered prices. And so that is the effect of an increase in the market risk premium on stock prices. It makes it go down. So what I've got here is that the market risk premium is generally considered to lie within the range of 3% and 7%, depending on the level of risk aversion in the market. Aswath Damodaran is a well-known and well-respected corporate finance expert with New York University. He estimates the market risk premium each month using a method similar to the discounted cash flow method that we talked about before for calculating the cost of equity. But he calculates it for the market rather than for a single security. He currently estimates the market risk premium at, in fact, he uses multiple different methods, and I will just pull that up really quick here. So here's his website. He does say on it that he knows it looks clunky, but it's how he likes to work. So instead of calling it the market risk premium, he refers to it as the equity risk premium. And this is the implied equity risk premium as of January 1st, 2024. You can see he's got 4.57, 4.60, 6.07. This is the trailing or the average cash flow for the last cash flow yield over the last 10 years, 4.43, 4.29. You can see many of these, with the exception of that 6% one, is in the range of 4.5%. So that's what I'm going to go ahead and use here is 4.5% for our market risk premium. Finally, we need to know what the yield on the 10-year U.S. Treasury is to get that risk-free rate. And so we'll go ahead and look that up as well. So the yield on the 10-year U.S. Treasury currently is 3.86. We'll just use 3.86%. So let's go ahead and use this information. We're going to go back out to Caterpillar and take a look at what the capital asset pricing model value is. So the yield on the 10-year U.S. Treasury, and I apologize, this should be 4.50%, was 3.86%. And so the beta for Caterpillar, we can go out and find that as well. And that is on that tear sheet that we talked about earlier. The beta for Caterpillar is 1.12, so it's a little bit more sensitive to market fluctuations than the average stock, but not much. So here I'm going to put in equals the yield on the 10-year U.S. Treasury, 3.86%, plus the beta of 1.12 multiplied by the market risk premium for the firm. Or 8.9%. And I'll go ahead and put the beta in here and use it in my calculation. So now we have 4 different estimates for the cost of equity for the firm, and there's quite a large range here for Caterpillar. The lowest required rate of return we have is the 8.9%. The highest is 38.24%. I'm going to stop the lecture here for this week because I want you to think about this. Not all of these can be correct. Okay? And so part of our job as financial analysts is to determine what the actual required rate of return is. We have evidence here, we have information here about different ways to calculate it. One thing I want to point out is that the yield on the firm's 10-year bonds is 4.59%. In other words, we know that bond investors right now are requiring a 4.59% return on the bonds of Caterpillar. Okay? If any of our estimates were lower than that for the cost of equity, we would throw those out because equity holders are going to require a greater rate of return than the bondholders. But none of them are really even very close to that number. The closest is the capital asset pricing model at 8.9%, and still that is 4.31% away from the required rate of return on the debt. So there's quite a bit of distance in there. So that's something to think about. We'll come back to this next week and talk a little bit about how we would choose what the actual cost of equity is for this firm. Okay.